Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Schwab Impact Conference. And with me today is Steve Cucchiaro, who's the Chief Investment Officer at Windhaven Investment Management, right?
Yes, thank you, Tom.
In Boston. Thanks for being here, Steve. Appreciate
My pleasure.
it. Listen, you've got a great history of your firm, and I want to spend a minute. You started as an advisor, is that right?
That's correct.
And then over time kind of evolved into a bigger firm where you were purchased by Charles Schwab.
Yes.
And now offer your investment management not only to other advisors but also individuals as well.
That is correct.
Tell us a little bit about how you got started.
Well, I could honestly say that in the beginning, I was perhaps the smallest investment advisor in the country. I had one employee myself, and I had a tiny amount of assets under management, but worked very hard on the research. Began investing using ETFs back in 1994 when few people knew they existed. Remember being told by one provider in the late 90s I might be their focus group of one, and then evolving the process. By 2002 began to build a team, so I was no longer just a one-person company. Assets really started to grow at that point. From 2002 to our acquisition by Schwab in 2010, we grew at a compound annual rate of 60% a year.
Wow.
And largely through ETFs.
And
now
you used ETFs the whole time?
The whole time.
Fantastic. So as a manager, what advantages did you see in ETFs way before many of us did?
My focus in the beginning was on asset classes. I knew the markets were much more inefficient at the asset class level than the security level. Therefore, you could add a lot more value if you can invest in asset classes. Then you ask yourself, what's the best way to invest in asset classes? And the ETF structure was by far the best way. Very cost efficient, very tax efficient, doing a great job keeping track of these indices and a better job than the majority of active managers. So for me, it was obvious that that's where I wanted to go.
Well, congratulations on your great success, but I have to ask you, as we're looking to 2012 and into 2013, with all the uncertainty that we've got going on out there, give us some ideas how advisors can position their portfolios, maybe overweighting or underweighting in certain areas.
Well, we think right now it's important to recognize that the global economy is stuck in a stalemate between the forces of debt deleveraging, government's trying to pay off all this debt, which should be very deflationary, and all the monetary stimulus that the central banks are promoting, all the money printing that the Fed is doing, other central banks around the world, should be very inflationary. So these two opposing forces have the world stuck in a stalemate, not growing fast enough to get back to full employment, but supported enough to stay out of a recession or deflation. So we think it's important to recognize that what determines the next steps, decisions by government officials and central bankers, no one can have perfect certainty as to what they're going to do. So we think it's better to stay diversified, keep investments and keep ETFs that will do very well if we do go back into recession. Also keep a classification of ETFs that will do very well if inflation comes back or if things start to.
So are you playing both sides of the fence right now?
We're very much playing both sides of the fence, but we are targeting certain asset classes we think will do well over the longer term. We think there are certain equity indices that themselves have collections of companies that have learned to make profits despite the fact the economy is not growing very fast. Companies that have very high sensitivity to cost of capital. We have record low cost of capital with the Fed driving interest rates close to zero. So there are some asset classes like international real estate that we've been advocating throughout most of this year, that of the 40 global asset classes and ETFs that we look at in the global economy, they've been the #1 performer so far in 2012. Asset classes like that.
Okay, a couple landmines. You've got to see that there are a couple landmines out there.
Yes.
What might they be?
Well, of course, everybody is talking about the landmines of what happens now after the election.
Right.
And we've had a situation where so many people have been anticipating the next steps. People are worried about fiscal cliffs and so on. And we believe the market is anticipating that the can will be kicked down the road. Not great news that we have a grand bargain, not terrible news that we go off the cliff, but we think the market's anticipating more just kicking the can down the road. What that means is if we do go off the fiscal cliff, then all bets are off. We could go back into recession, and we don't think the market's anticipating that. So we're watching like a hawk for those signs.
And you're poised to kind of move quickly based on what's going on?
That's right. We run our models more than once a day. We're meeting as a research team every day. We're meeting as an investment committee every week. So we think it's really important to stay tuned for whatever economic factors could throw the markets in a different direction, any fundamental factors, and also we pay a lot of attention to investor behavior and psychology, because that can act as a virtuous or vicious cycle.
Great. Well, Steve, thanks for your time today. Really appreciate it.
Always my pleasure.
Good seeing you.
Thank you.
This is Tom Lydon with ETF Trends.